In this video, I'll show you everything you need to create your bias. This will be the first episode of my free course, which I wish I would have had when I was starting. You'll be able to read where price heading to with the most important concepts I use on a daily basis. And in the following episodes, you'll learn every step after it, all the way to what to do after even setting a trade. I've made my first payouts within 10 months of trading. If I had this course, it would have taken me 2 months max, maybe even 1 month. I've spent countless hours creating this course, and my goal is to create 10,000 funded traders with it, which we will achieve. I'll cover every important thing in price action, so you don't need to watch any other price action videos after this course. This information that I'm going to share with you changed my whole entire life, so it will change yours if you apply it. Now, this is fun and all, but you might be wondering, who am I and why can I make these claims? I'm Oscay, aka Mr. Steal Pips for the OGs. I've got multiple payouts in 10 months of trading, which is all documented on my socials. I've dropped out of uni to scale my trading and scaled it to $500,000 within a few weeks. After scaling, I am back to finish my bachelor's degree in software engineering while getting consistent 10K months and even 10K weeks. The thing which I'm the most proud of is that I've been making consistent profits on my FTMO accounts every single month and also scaled up my FTMO accounts multiple times. Why did I really make this course though? Well, I hate the scams in the industry, so instead of complaining like everyone else, I'm being the change I want to see in the industry. It's takeover season. And it's also a funnel to my mentorship. I'm not gonna cap. The people that apply what I'm saying will realize that this is the real deal and will want to learn more from me, obviously, so it'll bring more interest to my mentorship. Hence why the quality of this free course will be insane. So you better capitalize on it while it's here. Now we got the obvious out of the way, let's get straight into business. Bias is your directional premise in price. So whether it goes up or down, you can also view bias as your draw on liquidity, because bias is nothing else than asking yourself, where is price likely reaching to? We create our bias by analyzing the clues the quote-unquote big institutions like central banks leave in the chart. Now, bias acts as a filter for you to view price, because if you do not properly create a bias, you can easily get swayed by every single price movement, and we try to evade that. Now, this module contains market structure, liquidity, power of three, candle closures, SMT divergence, market profiles, ranges, order flow, universal sequences, and at the end, I'm gonna apply them onto the chart and show you how you can combine them all. So don't worry, I got you. And every single subject has examples of application. So this is not just theory. I'm going to show you these in the real charts. Let's get it, man. Everyone already knows what market structure is, but I have a special way which allows me to not get baited by fake swings. So pay close attention, even if you already learned about market structure, because you're gonna learn the Oscay way. Now, market structure is simply the pattern of swing highs and swing lows that tells you who's in control, buyers or sellers. Now, a swing high is nothing but a 3-candle pattern with the middle candle being the highest one. Now, market structure helps you with your directional bias. Now, follow my mouse. We have a high, low, higher, low, higher, high. That's bullish, an uptrend. Now we have a high, low, lower high, lower low. That is bearish, a downtrend. And right here, when we have this extreme point and this extreme point right here, and you see price not making any structural changes, that is a consolidation. Now, how can we identify structure based on market structure? We have a high, low, higher, lower low. That becomes our market structure shift. And then once we retest it and break again, that becomes a break of structure. So a market structure shift is where the market structure shifts, you feel me? So it goes from bullish to bearish. And a break of structure is where it simply continues to break its structure into the same way. And now I'm going to give you the sauce. We have a low here and a high that gets confirmed with this break right here. Now you might be wondering, okay, why don't we use these highs as our highs? Well, listen closely. That is not the extreme high inside of our range. We do not take new highs until we get a candle closure. So right here, candle closure. So this is not our high yet, because we come back up, we come back up, we come back up, we come back up, and this becomes our extreme high inside of this range because it leads to this retracement. Now, I want to show you another example in the next slide, which will help you understand this better. But then we have a low, higher, lower low, lower high, lower low, lower high, lower low. And we follow these ranges with candle closures. You don't look for wick closures, because wicks can literally be liquidity sweeps. So we don't want you to get baited. Use candle closures. So right here we have a high, low, higher, and this would become a low then, right? No, because we never have a candle closure. So right here, once we fail to close above here, you don't anticipate a expansion immediately afterwards, which you can see right here. Do we expand immediately? No, we don't. So a lot of people would have gotten baited right here and lost their minds. So let's go back to the left-hand side. High, low, higher, high, Why don't we use this high? Because we don't close above it with a candle closure. We do that right here. And then you might be wondering, Oscay, why don't we pick this low? Because that's not the extreme low that caused the move up to the candle closure. We go up right here, retracement, go up, and then we break right here. We don't break it right here. So up until this point, we are bullish, bullish, bullish. Well, we use multiple confluences, so we would not be bullish here. I'm telling you, we're on the next level. So pay close attention because the next slides are going to go more in depth. But once we close under this low, this becomes our high, and then this becomes our low. And then right here, price fails to expand down. So this is a consolidation, a beautiful example of a consolidation until we break right here, we retest and we instantly expand. You see, once we exit a consolidation, how you get beautiful weeks to trade. And then we have a low into a higher high. So this becomes our market structure shift. And this right here, once we retest it and then we break back up, that's a break of structure, like right here, high, low, higher high, that's a break of structure because we did not change our trend. Now we're going to get to the more fun part, the liquidity. Liquidity is resting orders at predictable price levels, such as stop losses, buy stops, sell stops that have not been triggered yet, which we use to rinse the market. We're trying to get some liquidity before we continue the move. Why? Because market makers purposely engineer liquidity to use those as their counterparty. If you were a central bank, you can't just sell €1 billion out of thin air because that would tank the market like crazy and which would make them get filled inefficiently. So you need to have a counterparty. And how do we create a counterparty? By engineering liquidity. So what does the market always do? It engineers liquidity, manipulates, and delivers the move. And you will see this happening over and over and over and again. So if there's something you should pay attention to, it is liquidity. Now we have an example right here. Look at how we take the highs, we expand. We take lows, we expand. We take highs, we expand. It always does the same thing. And your job as a trader is to find these highs. And I'm going to keep it a buck. I made this presentation a while back, but these are quite significant highs and lows. I think maybe even yearly highs and lows. So you see, every time we take significant liquidity, price expands. Can that be a coincidence? You tell me right now. Go and look at your chart. You will see. So sweep, expand. And before we expand again, what do? We sweep. Yeah, as I said, this is probably yearly liquidity. And this is the yearly chart. And you can literally see that this does not make any sense, man. I'm telling you. Yearly high swept, expand. Yearly low swept, expand. Yearly high swept and expand. I'm telling you, once you master these markets, you will be laughing too because it's literally fake. It is fake, fake, fake. And you're going to see why. So yearly low swept, expand. And when do we reverse? Oh, when we sweep a yearly high. Make it make sense, gang. Like you cannot make this up. Just beautiful. Here I have removed these big black bars, big red bars to make it look simpler. Just beautiful. Oh, this is another example I wanted to show you where you can see even in a consolidation, it happens the same. We sweep liquidity, we expand until when? Until we sweep liquidity. So once we sweep that liquidity, we wait for a candle closure, which you will learn in the next slides, and then price expands again. And where do we expand to? To liquidity. And after that, to where? To liquidity. So you're going to learn how to predict these moves. Don't worry, I got you. Another example on the 4-hour time frame. When does the 4-hour time frame expand? After sweeping liquidity, expansion. What do? We engineer liquidity, we sweep it, expand. Engineer liquidity, sweep it, expand. So if I can give you one tip right now, pause, that sounds crazy. I ain't giving you my tip. If I can give you a tip, it is, man, I'm crazy. So no diddy, no diddy. It is to focus on liquidity. Liquidity is what drives these markets. If you understand where liquidity lays and you wait for a few confirmations, you can rinse it on another level. Power of 3. I always have this in the back of my mind, and you need to have this in the back of your mind too. So rewatch this until you drain it into your mind. A power of 3. A candle shows the market's price movement during a specific time period by showing where it opens. So open, what the highest and lowest points are, and then where it closes. So if the opening price is lower than the closing price, then it's a bullish candle. And if the opening price is higher than the closing price, it is a bearish candle. Now, to understand the markets on a deep level, you need to know the power of 3, which is accumulation, manipulation, distribution. So you will see me use those words interchangeably. AMD, power of 3, it is the same. Like they use so many words for the same stuff. That's why you just need to trade the charts. Don't need to learn the words. Alright? You just need to master the charts. So, what is AMD? It is accumulation where the market engineers liquidity. And then we have a manipulation where the market baits everyone too long because this looks like a breakout. While we simply wait for the reversal, for the manipulation to be done, and then we get a huge distribution. And we finna milk that day in, day out, no diddy. Now, to visualize it, this is why people get baited. They see a bullish candle, they chase it, but we wait until we get the manipulation. And then it suddenly becomes a bearish candle, and everyone that was long gets wrecked. And while they get wrecked, they still have the same sentiment because you know how people marry the bias, and you can't be one of those. Listen to me. We don't marry the bias. We marry the manipulation, no diddy. Man, I need to chill. Alright, so after we have the manipulation, we have the distribution right here, and you can see we want to catch a piece of that body. We want to position ourselves inside of the wick of the candle. Now right here, you can see the power of 3 happening inside of a weekly candle. This is the weekly candle right here on the left-hand side. So it opens up, Monday manipulates, Tuesday reverses, so we can anticipate the manipulation to be done on Tuesday, and Wednesday and Thursday expand. Now, if you trade with this in the back of your mind, is it not going to be easy? You won't be in the lower time frames on Monday, losing your mind. You'll just wait for Tuesday to set the reversal, or you just wait for Wednesday. Like you can choose how you want to trade, and you will learn how to trade. Like, trust me, pay close attention. This free course, like this free course is better than all the paid ones you've bought. So pay close attention. So inside of this manipulation right here, you don't want to position yourself on Monday. You want to do it on Tuesday and Wednesday. Right here, we have a weekly candle, which reached the previous year's low. And what did I tell you about liquidity? These previous year's liquidity holds some significance. So we're going to zoom into this candle right here. Monday accumulates orders. Tuesday accumulates orders too. Wednesday sets the high of the week with a manipulation and expands down. So then Thursday continues. Friday continues too. What happens? This weekly candle is a bearish one. And that's how a power of 3 gets formed. You wait for the manipulation to be done, like on Wednesday right here, and then you trade with peace of mind. This will be a more important one because I wish I learned this earlier. Candle closures are so overpowered and I did not properly use them because they look too simple. But simplicity is key. Pay close attention because the way one candle closes, like, explains the whole story in price at times. So focus on it. And by coupling the intent of a singular candle alongside the other concepts, we can anticipate the next candle is delivery. So power of 3. This is a reversal sequence. As you can see, the middle candle sweeps the previous candle, and then the next candle is likely to expand. So when you see a candle sweep the previous high, close back inside of the range, anticipate the next candle to be an expanding one. Now for a bullish one, it is the exact same, but reversed. We sweep previous candle's low, close back inside of the range, so we anticipate the next candle to be a expanding one. Now, you might be wondering, Oscay, how can we know that the second candle will hold? And you're gonna learn that later, bro, with the SMTs. That's like a chef's kiss. It is so overpowered. So just keep paying attention to the free best course ever. We also have another reversal sequence where it instantly expands after sweeping the previous low. So it does not always need to look like this, where the second candle is a small one. It can sweep and explode instantly, and you wanna know how to be in that, right? Now, how do we know that? With SMT, which you're gonna learn later. Now, then we also have the continuation sequence. So after we sweep the previous high and we close under the previous low right here, that's a sign that the next candle is likely to expand down. Knowing this, you can literally predict the markets, and I'm going to show you in examples. What do we see right here? The same, but reversed. We sweep previous low, close back inside of the range, and the next candle closes on previous high. What do we anticipate? The next candle to expand to previous day's high. Excuse me. This can be any form of liquidity, by the way, so it does not have to be previous day's high. I just used that as an example. This can be previous week's high, previous month's high, previous hourly high. Now, a beautiful example right here. This right here is the weekly candle, and this right here are the daily candles inside of the weekly candle, which we have seen in the previous example. So I'm not going to go over it again. So what do we anticipate Friday to do? Open up, manipulate, power of 3, expand to the previous day's low, and to our draw on liquidity. That's how simple it is. Another example, we see a high, we sweep that high, we close back inside of the range, what do we anticipate the next candle to do? Attack the low. Why? Because this is a reversal signature. Now, the candle after the reversal closes under the reversal. So what do we anticipate? The next candle to attack the lows. Exactly. So once we take the lows, expand back inside of the range, what do we anticipate the next candle to do? Attack these highs. Now, did we close above those highs? No, we didn't. So what do we anticipate this candle to do? Close below these lows right here. Now again, once we have closed under there, the next candle is likely to attack the low, but it closes under there. So what is the next candle likely to do? Attack it. Then we close under it again. So this white candle, we anticipate this to attack this low first, but we don't know what will happen. It can continue or not. And it shows us right here that it puts in a reversal signature. So then we anticipate the next candle to open up, take this high, and then we don't know what will happen. We'll just wait. And then once this closes above here, you can already anticipate the next candle to again expand to previous day's highs. And that's how simple it is. That's why I told you candle closures are so overpowered. You just gotta zoom out, determine what the daily candle is gonna do, and enjoy your life. We came to one of my favorite concepts which changed my trading so much, SMT Divergence, which is smart money tool / technique, and it indicates a crack in correlation between correlated assets because of what we speculate to be smart money activity. So as you see right here, this candle fails to make a higher high, while this candle makes a higher high, which is SMT divergence, because correlated assets should move in sync. When they do not do that, there's some green light, and then we capitalize on that. We believe that algorithms are booking price, which leave clues. One of those clues is smart money tool / technique. I just call it SMT. Reverse engineer every expanding candle, and you will see that what I'm saying holds great truth. So you need to know this concept. It is so important. Focus up. Right here, you can see a SMT divergence inside of the daily fair value gap. The left chart is Euro USD. The right chart is Pound USD. These are correlating assets which should move in sync. So when EU sweeps this high, GU should also do that. When it does not do that, it is a crack in correlation. You can see EU sweeps the high, GU fails to sweep that high, and where do we get the high of the week? Where do we get the high of the week? Right there. Make it make sense. Study price. You will see every single week almost has SMT. And if your pair does not have SMT that you're trading, probably another correlating pair has it. And your mind will be blown, trust me. Another example. EU sweeps previous day's high. GU fails to do so. And where is the high of the week? Right there. Make it make sense. Does it make sense? It's crazy, right? Where's the high before the expansion now? It is right there on the SMT. When we zoom into price, you can see we sweep Monday's high, making this the high. Then we just follow the train down. You see the SMT? You follow the train down. You feel me? Now for SMT divergence, I use 3 correlating instruments usually to confirm my sentiment. Because sometimes EU and GU move in sync, but DXY makes a cracking correlation. For this free course, we'll focus on EU, GU, and DXY. And you can use Euro futures and Pound futures too for your SMTs. Now, there's multiple other markets, but I will not go over them. But one example I can give you is the S&P 500, NASDAQ, and Dow Jones. Market profiles describe what phase of delivery the market is currently in. And we want to trade on the highest probable markets, right? Which are the expansions. The market does not always deliver expansions. Sometimes it retraces, consolidates, reverses. We have to anticipate what profile is happening next, or we're finna get baited thinking it's gonna be an expansion and get wrecked. No, we don't want that. We want to trade in the highest probable scenarios. A expansion is when price moving strongly and impulsively in one direction. Big range candles like you see right here. And it's leaving imbalances usually when it is expanding. This is the phase where price delivers to a liquidity pool with speed because of the algorithms that are actively pushing price towards the target. Look at this example. We sweep liquidity, expand. And then what happens? We retrace and expand. Again, this is an expansion phase and you need to position yourself inside of an expansion phase. And I'm going to give you all a gem. Once we reach our liquidity pool, price can do whatever it wants. So once we reach the liquidity pool, you don't know what's going to happen. Then you can anticipate a reversal, consolidation, retracement, but not expansion to Narnia. That does not work like that because then everyone would make money. You feel me? Another example of a expansion. When do we see a expansion happening? When we sweep liquidity. Yes, sir. So, did I just give you a gem? Yes, I did. So focus on liquidity sweeps. That's where expansions originate from. Where does this expansion originate from? A liquidity sweep. Exactly. You're starting to get it. You're going to become like Big Daddy Oscay, no Diddy. A retracement is where the market pulls back against the initial move. It's usually corrective, weak, and shallow. Usually, I did not say 100% of the times. So would we like to trade retracements? Ideally not. You want to master expansions and then you learn retracements. You don't want to waste your mental capital in retracements unless you're like me and you can trade any move. But that comes with experience. I've been trading for a long time, G. I lost my mind for a long time. So first master expansions and then you can lose your minds in retracements and master them too. So what do we see? Expansion, retracement. Expansion, retracement. Expansion, retracement, expansion. It's simple, right? I should have looked like this. Retracement, not retrace them. Now, reversal. Price shifts direction entirely. The prior narrative is broken. So if we were in a downtrend, the prior narrative is broken because we just broke to the upside. You'll see a strong displacement in the opposite direction, which is called a market structure shift. And this usually happens with a liquidity sweep before the move. Or I'm going to give you a gem. A SMT. Note that down. SMTs are everything. Is the last key. Like once you master these, you will master anything. So what do we see? Reverse, retrace, expand. With a high, low, low, higher, high. So this is a reversal right here. Then we have a retracement and an expansion. Now consolidation. Price is just stuck. It's ranging between two PD arrays with no clear expansion in either direction. So both sides are balanced and it's just going to wreck people, creating more liquidity. So institutions are either accumulating or the market is simply waiting for a catalyst, and a catalyst could be news, time of week, time of day. So what can we see right here? We have a low, high, lower low. So this is our new high, this is our new low. What does price do? It fails to displace above previous high. And then we have a candle closure with a huge wick. What did I explain you about candle closures that don't close strongly above previous highs? It closed strongly above here. That would mean this candle should expand up here, right? But it didn't. It closed back inside of the range. And that immediately should tell you that we are likely to consolidate. So literally, two candles can tell you the whole story of price. And then you can evade all this consolidation and not lose your hairs. And after we break this high, so that becomes then a reversal, we immediately have a retracement into expansion. So when does this expansion happen? Immediately when we get a candle closure above previous high. So did I just tell you the biggest market structure shift cheat code ever? I did. Enjoy. Now, again, we have a high, low, higher high. This becomes our reversal, retracement, and then we expand, we reverse. So as I said, the retracement should be shallow, right? It's not always shallow. Look, this retracement, it almost is the same move as the expansion. But this retracement is smaller than expansion, and this too, and this one too. So I said it's probabilities, and you should know that too. So once you see price expanding like crazy inside of a retracement, you don't follow it. You know the market profiles, and this is a retracement profile. That does not mean that when it retraces, it should always be shallow. So that's how you do not get baited. You don't think this is going to continue to expand to Narnia. No, you know it's going to end somewhere, and once it ends, that's your moment to snipe. And once you master those, it's wrapped. Now, this was the consolidation example I've shown you. Look at that consolidation, man. You don't want to trade in there unless you're like me. And you're going to learn that too, to trade inside of the craziest consolidations. So don't worry, you're going to get that later. One of my favorite concepts is ranges. When you know your range, you know where price is going to retrace to, you know where it's going to expand. You don't need to pull your hairs out anymore. I've been there, done that. So listen closely. A dealing range is a defined boundary between a significant high and a significant low. Well, what is a significant high and low, you might ask? Once price breaks structure, we create a new high and a new low, right? So those are the significant highs and lows. So a dealing range is a reference frame within which price is currently delivering. So inside of that reference frame, we look for premium and discount, and we buy in discount, which is the lower half, and we sell in premium, which is the higher half of the range, if we are bullish, obviously. Now, every price move exists within a range. And ranges nest inside each other across time frames. And you'll learn time frame alignment later, but so that's how you can trade retracements inside of a bigger lag. Okay? But I don't want to confuse you right now. Just focus up. You can use ranges in any time frame, any given time. Institutions don't buy and sell randomly. They buy when price is cheap and sell when price is expensive. What I just told you, discount and premium. So the dealing range gives you the objective framework to determine which one applies at any given moment. So right here we have a low that breaks a high, we retrace, then we break another high. So this high to this low is our new range. This upper half is premium, this lower half is discount, and the middle is equilibrium. Alright, focus on that. Now let's go to the bigger example. This is the daily Euro USD chart. We have a reversal set, retrace, expansion, retrace, expansion, retrace, expansion. Now, when do we retrace? When do we expand? Once we break this high, you can see this candle close back inside of the range. So you anticipate this to be the high of the range and this to be the low. And then the next candle is likely going to retrace. You don't know if it's going to do it in 1 day, 2 day, 3 day, 5 day, million days. You don't know. But it's going to retrace, high likely to discount. It retraces right here to discount and then it expands. So once you know this on the daily time frame and you want to trade the expansions, right? What are you going to do? You won't buy when price is right here in premium. You'll wait until it drops into discount and then buy. So now, listen to me. I've been where you've been. I've lost my mind. I entered too early tons of times. I had to learn this stuff myself. You're learning it right now from me. So don't make the same mistakes as me and just buy in discount, sell in premium. Don't buy in premium. If you go to the store and you see the store literally says, we're going to have a discount next week, 50% off everything. Are you still going to buy? No, you're going to wait for the discount. You feel me? So don't buy in premium because 1 day passes, price reaches discount, and you can buy then. Because it has reached discount. It has reached a point where we would likely want to transact from. So let's zoom into price action right now. It looks beautiful here. But on the 4-hour time frame, you see way more candles. You get confused. You don't know if price is going to reverse, retrace this, that, blah, 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 blah. Now you do because you have your daily range set. You have your alert set. You hear beep. That's the alert of TradingView. You hear beep, beep. Now you hear like a beep and then you look at the chart. You don't look before that because you're going to waste mental capital and you need to save the mental capital for the expansions. So what do we see? 1, 2, 3, 4, 5, 6, 7, 7 candles, 7 4-hour candles, retracing. You don't want to look at that. You want to look when you hear the beep, and then you look to position yourself in the expansion. What happens right here? We break the range, retrace the discount, expand, retrace the discount again. Now let's zoom in one more time. Now it looks extremely confusing, right? And this is where you all get lost. But once you use these ranges, you can enjoy your life, gang. Like, don't be like me, lost in the sauce. Be the sauce. No. Wait, I got a bar right now. I'm giving you the recipe. So enjoy the sauce. You can make the same sauce and enjoy life, gang. Order flow is the directional momentum behind price right now. It's about which side is in control. And once you learn this, you learn when to anticipate reversals, retracement, consolidations, everything. Because price tells you what's happening by just looking at it. So the way we determine this is by looking at what PD arrays get respected or disrespected. Now, what is respect? What is disrespect? When price respects something, it should displace away, move away. When it disrespects, it should show little to no reaction. It should disrespect. It should move into its house. And when the PD array says, get out of my house, it ain't moving out the house. It's just staying there. It's disrespecting the PD array. I hope that analogy helps you. So, market structure gives you the big picture direction, but order flow tells you whether that direction is being backed right now. That's a bar, write that down. Market structure gives you the direction, order flow tells you whether it's backed. So this allows us to anticipate which market profile is likely to occur. Let me show you the example. Bearish, retracement. Now we reached our first PD array. Once we reach our first PD array, we are going to look if price is going to respect it or disrespect it. Right here, you see it respecting it, and it creates a move, which you could have potentially traded, right? And then once it fails to close under this low, you already, like, if you use the candle closures, you know that we are likely, if price is not opening and manipulating down, we are likely to go up And now we're back up inside of the daily fair value gap. You see a sweep of this high and it closed back inside of the range. You see how far we displace away after sweeping the high inside of the daily fair value gap. That tells you it is high likely to get respected. So after it gets respected, we expand away. Now what happens then? Price comes into this daily fair value gap, is disrespecting it. Look at that. This candle ain't showing any respect that is going to go down. It's literally closing above the previous candle, so we anticipate the next candle to expand. So when you anticipate this candle to expand, you wait how it's going to react at previous day's high, because I just told you in the candle closure slides. So once you see this candle bang expand up, what did it just do? It disrespected this fair value gap. It don't give a F about this fair value gap. So what do we anticipate then? That order flow is getting disrespected. So are we still bearish? No, because if we were to be bearish, would price disrespect this fair value gap on this level? It would not. So then we create a order block right here. And then price expands, retraces into the order block, gives a huge reaction from it. It respects it. Bang, expand. Fair value gap, price retraces, expands, bang. Then what happens? We have this order block right here. This order block almost makes price move up, but then we respect it, then we disrespect it right here. We have disrespected it on such a high level that this likely, if we sweep this, we have to expand now, right? But then we failed to do so. So once we disrespected this order block and did not move up here, what is high likely going to happen? We are going to continue to disrespect it, and then this order block becomes a breaker block. And what do we know about breaker blocks? Those hold price like linebackers. Look at this. Tap the breaker block, bam, expand. Then we have this blue fair value gap right here. Price moves into this fair value gap. Huge wick, expansion. You could have potentially traded that. Retracement, huge wick, expansion again, back down. And one last time, like you can see, it is respecting the daily fair value gap. It's not closing through it like a maniac right here. If it closes through it, you would be like, damn, maybe it ain't finna respect it. You feel me? But right here, wick, wick, wick. We sweep previous high, expand. Sweep previous high. So if this was to disrespect the fair value gap, it should close bullishly above this high, right? And we failed to do so. What did you learn in the candle closure videos? If we fail to close above the previous candles is high and come back inside of this range. So this candle is a range, right? We sweep, we come back inside of the range. Then you don't anticipate the next candle to boom, expand again. That does not make sense. This candle is showing you intent that it is not ready to expand. So the next candle is reversing into us. Well, not into us, because we would have expected this, because we read order flow. Now, another example, fair value gap, retrace, expand. Fair value gap, retrace, expand. Now we are stuck in between two PD arrays. And you're going to learn in the next module about low probability conditions that this can be low probability conditions if you're not a master at price like me, because we are stuck between two PD arrays. We are likely to go up, likely to go down. So everyone sees this fair value gap and thinks that they can long from it, but no, take a step back. We are stuck between PD arrays. So then you need a few more confluences before you can trust if this fair value gap is going to hold or this order block right here. But what holds price? The order block. You can see price respects it. Wick, wick, wick. It ain't disrespecting. It ain't closing inside of it. Now we respect it and then we expand down. What happens? We close strongly through this fair value gap. Then we have a new order block. Retracement, expansion. Retracement, expansion. You see how price respects and disrespects PD arrays will tell you everything you need to know about price. Universal sequences will put it all together, because the universal sequence is a natural order in which price moves through ranges. It describes the full cycle of how price delivers from one level to another, specifically between internal and external range liquidity. This is the most important thing in my opinion, as it allows you to systemize price delivery. So when you note down your bias for the day, you will note it down in this way. Alright? This then allows you to correctly quantify your data, and when you quantify your data, it allows you to refine your model on a professional level. So this last piece is putting it all together is the most important, trust me. If you do not do this, your data will be useless, gang. So listen up. We have three universal sequences: internal range liquidity to external range liquidity, external range liquidity to internal range liquidity, and external range liquidity to external range liquidity. Now, what is internal range liquidity? what we have just seen. Once price makes a new range, everything inside of there is internal. So this right here is internal range liquidity. We come back and expand. What is external? So outside of the range. So right here we expanded, we created a new range, this low to this high, and we retraced. And this then is our external range high, and then we attack the external range liquidity. Let's go over the first example, internal to external. Price moves up, retraces, closes back inside of the range. And if you remember in the candle closures video, what do we anticipate for the next candle? To expand. Oscay, was trading always that simple? Yes, sir. You might be wondering, how can we confirm that this will be actually the low that will hold? We do that with SMT. And guys, if I can drill one thing in your brain, is to learn SMT. SMT can either occur at the previous candle or the candle next to it. That's why I love trading intra-session. You just want to be in and out because you don't know whether this will be the low or not, because it can always sweep it again and then expand. Now, price does not always have to move up instantly and beautifully like in the previous slide right here. It can also create a miniature candle, and then the next candle closes above it, confirming your sentiment for the next 2 days. So you don't need to get FOMO in these price moves. You don't need to want to catch this low or even this low. You do that once you're advanced. I want you to drill that into your brain. Do not get FOMO. This candle can confirm your sentiment for the whole entire week, and then you can trade every day after it. Alright? For external range liquidity to internal range liquidity, we wait for price to sweep a external range high and then confirm our sentiment by closing back inside of the range. And you can trade this reversal or the continuation to internal range liquidity. Now, how do we know that this external range liquidity will hold? With a SMT. That confirms it to us. Now then we have our last one, which is external range liquidity to external range liquidity. And how do we confirm that? When you see price closing beneath the previous candle's low, what did I tell you? It is likely to expand to the next low. So once we see price close under this low, failing to respect this internal range liquidity, if you've paid attention in the order flow section, then you would have already understood that the next candle is likely to what? To attack these lows right here, which are external range liquidity. So we do not respect internal range liquidity, but we anticipate price to attack external range liquidity. Let's go through a example, man. When I put this fluff on the chart, you can see that what I'm saying is just enigma. So enjoy. What do we see? Internal range liquidity to external range liquidity. Then we have another internal range liquidity. Sweep, expand. What happens here? Internal to external. Now from external, we get a huge reaction to where? To the external range high. Do we expand through the external range high? No, we respect it. So what do we anticipate? External to external. Because if we want to see price go through it, we need to see candle closures above it. So we have a external to external example right here. External range liquidity to external range liquidity. Then this is our internal range liquidity. We retrace. After sweeping the previous low right here, the external range liquidity has been swept. Yes, anticipate a retracement. Bam, we come into this volume imbalance. Respect it. Internal range liquidity respected. We anticipate price to move to external range liquidity. Now, close below it. We have another internal range liquidity. Retracement, expansion. Retracement, expansion, retracement, expansion. You get it by now. This is how the market moves, and you need to label your trades in this way. So this is the weekly chart. How would you label your bias? For example, on the last move right here, what would you label your bias? Weekly internal range liquidity to external range liquidity, and then you target these lows. You already know I got you. We're going to go over multiple examples applying everything, so pay close attention. Now, if we zoom out to the monthly on Euro USD, what do we see? We see a bearish market structure. You might ask why? Well, this is why. We have this break, reversal. You could see this as a low and then this high. And then we don't have any proper breaks anymore. So this will be my last low and this will be my last high and this will be my last low. So if you just mark these both out, this is our monthly range currently. Now, what did I tell you guys about using order flow? So if we currently use order flow and we were bearish, right? What do we see? We have this overpowered overblock right here. We disrespect it. So order flow is immediately telling us that we are not respecting the bearish market structure. So I'm gonna keep it a buck. I don't care too much about the bearish market structure because the market is clearly telling me that we are ranging. So until I see proper displacement and a new market structure, I do not believe it. So what do we know about the monthly market structure? It is not backed by order flow, so it is neutral for me. So when it's neutral, then I'm not going to anticipate like a continuation of the structure. What do we see after that? We see a monthly high sweep and a close back inside of the range. Where do we see that signature as well? Here. We see the signature here. We see the signature here. So you can see the market does not, even here, the market does not follow through. So if I see that, what do I expect? A monthly power of 3 to where? Back down. So if I look at price, the monthly candle has already opened and it has already displaced down. Where does my eye go to? This monthly fair value gap right here. So we have taken the monthly fair value gap. Now with this info in my mind and with the market being neutral, like I'm not expecting this to immediately hold, because look at this. We failed to hold it here. We held it here, but look, we had a reaction, then a reaction again at the previous month's high. So this fair value gap did not push price up. So if these two fair value gaps already tell me that order flow is not likely to get respected on the monthly, am I going to trust this one? No, I'm not. So then I zoom out and I confirm my sentiment with intermarket analysis. So as you guys know, I have Euro US dollar right here, Pound US dollar right here, and DXY right here. Now you might be wondering, why is this DXY in sync with these two assets? It is because I have my DXY chart inversed. That way it's easier to read price on my eyes. Now immediately what sticks out to me is this SMT at this monthly high right here between EU, DXY versus GU. You can see that GU sweeps it while EU and DXY fail to do so. So let's see what kind of high this is, because it pretty much looks like a yearly high, which holds extremely much significance, and it is a yearly high. So we have a yearly high SMT occurring right here on this candle. So if EU, let me just zoom back to EU. So EU does not take the yearly high, but because GU does so, we are trusting that EU also has taken it, because there's a cracking correlation, and that means that smart money is in play. So even though this liquidity pool is so close and it's a strong one, the SMT tells us that we do not have to take it because we have already taken it on GU, which leaves clues of smart money being in display. Now, so the monthly is neutral and we have a previous month's high sweep with a yearly high sweep, so we are anticipating some relief in price. Then we zoom into the weekly and we do the exact same thing. Wait, let me actually mark this like this. SMT, previous year's high, EU and DXY versus GU. If we go to the weekly, what do we see? Let's see if the market structure on the weekly is getting respected. High, high, high break. I'm going to go through it a bit slower, excuse me. So we have a low, high, break. We break this high, we break this high, new high, and new low. We break it? No, we don't. We break it right here. So I'm going to remove everything. And this is my new low. This is my new high. Because we break this low here, right here. So actually this becomes my new low and this becomes my new high. So right here is our weekly range. I'm going to take the range tool and I'm going to drag it to the right. What do we see? Is premium, so above the range, getting respected? No, it isn't. We're not respecting this fair value gap right here. Let me actually zoom in because it's quite hard to mark it out. We're not respecting this. We are not respecting premium of the range. And premium of the range does not even matter. Why? Because this is a breaker pattern. So price should immediately expand from here. That's a jam. Note that down. Breaker patterns are extremely strong. So once we see price disrespecting the breaker pattern, disrespecting premium of the weekly range, I'm going to put that range again here. Disrespecting premium of the weekly range, disrespecting this fair value gap, we already know that it's capped. This market structure is capped because order flow is not back in it. So I'm going to remove it and I don't care about it because clearly price is telling us that you should not care about the market structure. Order flow is literally telling us it's capping. So we have this SMT at the previous year's high with EU and DXY versus GU. And what do we see? We immediately see that we have a high, low, higher high, lower low. What is that? That is a breaker. So we have a weekly breaker right here. What do we know about breakers is that this is the strongest algorithmic pattern in price. It is a reversal signature. So immediately what I'm thinking is that we are going to get a candle like this on a weekly time frame. So let's now use the multiple markers to see if there's SMT. Let's go over GU first. Nope, no SMT on GU. And let's go to DXY after that. Look at my mouse. So when I'm with my mouse on this candle right here, it highlights the same candle on GU and DXY as a vertical line. Do you see SMT? No, we don't see SMT at the highs. So I go back to the weekly and I make my conclusion. I'm expecting this weekly candle to be bearish because we have swept the monthly high right here, closed back inside of the range. We have swept the previous week's high simultaneously while doing the monthly high, closed back inside of the range. We had a power of 3. So that's basically just a candle. This candle failing to take this high and closing back under this low right here, while simultaneously closing under this breaker. So I'm anticipating a weekly internal range liquidity to external range liquidity. So what I'm going to mark so it's easy on my eyes is this previous week's low right here. And I will do that on every single asset, by the way. So let's go here. I'm just copy paste it. Previous week's low marked on GU. And this candle is glitching, is already showing. So let me just play price back. So previous week's low marked right here too. Oh, then what catches my eye immediately is that we also had this SMT, which we did not see. So we have a SMT at the previous month's low, EU and DXY versus GU. So that is a huge red flag, which price could potentially use to be bullish. So right now we have price potentially going down from the weekly breaker or potentially going up from previous week's low. And then we zoom into the daily to see what price will do. Now I'm on the daily right here. Let me put these lines properly. Now, beautiful. This is the weekly breaker, key level for us. Previous week's low, also a key level for us. So I'm asking myself, in my bias, if we are to go down, where are we going to go down from? Weekly breaker. If we are to go up, where are we going to go up from? Previous week's low. Now we are basically going to anticipate if the weekly candle is either going to open, manipulate down, expand up, or if the weekly candle is going to open up, react at the breaker, expand down. And we are going to do that based on deciding what our universal sequence is going to be on a daily time frame. Now, let's play price forward. Then you're going to see how I'm going to create my bias. We have Monday, which is an inside day. Now, if we zoom out, we can see that GU has immediately swept previous week's low, while EU failed to do so, making this our SMT. Now, then we are going to look if price is going to react bullishly up. Now, we have a candle which is closing like this. So, if we go into price and look if GU also swept previous day's high, that would give us signs that the markets are in sync and potentially this SMT at the low will hold. But you see that GU fails to sweep while EU sweeps inside of a key level, the weekly breaker and the daily fair value gap. So if we then keep the power of 3 in our mind, then Monday was the accumulation, Tuesday high likely manipulated, and then we can anticipate a continuation. So what I would think right here, looking at price, if price was bullish, this should have pushed it up, right? But it failed to push it up. With this, I mean the previous week's low SMT between EU and GU. It failed to push it up. Now we have a previous day's high SMT. And if you study price, you will see that a lot of the highs and lows of the week get made with previous day's high SMT. So I trust this previous day's highs SMT over previous week's low SMT on Monday, which is also a red flag, because why would Monday be the day that instantly manipulates when we have no accumulation. So when I zoom back out and go to the weekly and look at how our weekly power of 3 is getting created, I am still extremely confident in shorts. Why? Because we disrespect this fair value gap on another level on the weekly. So when I see price moving down like this with the SMT at the lows, I'm just assuming that is a manipulation, because my high and low of the week usually happens on previous days SMT. And note that down, there's a little jam I'm gonna give you. So what would I take as my bias right here? The weekly open, high, low, close is still intact. So I'm anticipating this potentially to be a Tuesday high of the week, or we can get another sweep right here to then be the high of the week. So let's see how price develops. The next candle immediately manipulates up and drops down, closes under here. So what do we anticipate the next candle to be? Bearish. And then the market closes like this. So we zoom out and we go and look on the other assets. And with the market closing like this, we are anticipating that potentially the weekly candle is done forming and we would be done on Thursday. And that's how you get your bias. So let's just see the Friday candle right now, and it's closed as a inside candle. And then if we zoom out to price, you can see that it closed bullish on GU, and on DXY it's also a bearish candle. So that already indicates to us that there's low probability conditions, and you will learn them in the next module, don't worry. So let's zoom out and do a quick recap, remove everything. What do we see on the monthly? We see a previous month's high sweep, and then price instantly melts down. Then we go to the weekly. We have a weekly breaker pattern. So we anticipate the next weekly candle to be a open, high, low, close. What happens? Beautiful. Then we go into the daily and we look for our daily key level to frame shorts from, which will be either this daily fair value gap or this SMT right here. But this SMT right here failed to deliver us a proper reversal signature, which we did get inside of the daily fair value gap. So we were bearish after that, and then it delivered a beautiful bias, which was daily internal range liquidity to external range liquidity. So let's go over another example. I just quickly picked this one out. I did not practice it, so y'all gonna see it like live in backtest. Alright, so let's go to the 12-month chart, because I'm actually curious if we took a yearly high, which we did. Let's then go to GU and DXY. On all assets, we took the previous year's high. So that's a huge, beautiful sign that we are likely to go back down. Why do I think this is a yearly high? Because look at this monthly wick right here. That immediately told me, like, we're not reacting for no reason like this right there. So then obviously monthly order flow. We have swept this low. Let me mark it like this. We have swept this low right here, expanded up, retrace, expand, fill to expand, we sweep, come back down. So right here, you already know, man, let's get it. We failed to expand above previous highs. So my order flow is immediately neutral. Now, then I'm going to simply look at candle closures. Did this candle right here manage to close above it? Let's go to the other assets. All assets failed to close above the previous high, making me trust the price is likely neutral on the monthly time frame. So then let's zoom into the weekly. Can we see a weekly proper market structure right here? Which we can. We close above here. So we have our low, high. What happens then? We fail to close above this high with a huge wick, and then we fail to close above that high again, making me trust that this order flow is also neutral. So I don't really care about the market structure, because it's failing to push above previous highs. That means the market ain't expanding. So next thing I'm checking on the weekly is we have this weekly high sweep from a weekly fair value gap. So this weekly fair value gap, if it wanted to hold, I would like to see it close above the previous week's high, which it failed to do so. I'm going to mark this like weekly fair value gap. And this is previous week's high. So let's zoom out and look what the other assets did. GU failed to close above it, and DXY closed above it, but we have EU failing to close above it, GU failing to close above it. Only DXY closed above it, so it is two markets against one, and that's how you use intermarket analysis. Write that down. And if we look, we can see that EU sweeps it, while GU fails to sweep it, and DXY also sweeps it, which makes this a previous week's high SMT, EU and DXY versus GU. So then let's zoom into the daily. On the daily time frame, it is looking low-key disgusting. Why? Because we have a daily fair value gap here. and a daily fair value gap right here. So price is stuck between PDRAs. So that way we zoom back to the weekly. If I see the weekly like this, I'm gonna keep it a buck. I'm expecting the week to open, potentially manipulate up again, take this high, or manipulate up small and then expand to take these lows, because a weekly fair value gap should push price up. If it fails to push price up with a SMT at a weekly high, I'm anticipating this to be a failed push to then potentially take this low. So my next target is this weekly low right here, simply with the way the candle closure is popping up. So this is a real previous week's low. I'm gonna keep this right here as well as previous week's low, because this took this previous week's low. Now let's play price forward on the daily. And with the way I see price, I'm gonna zoom out and see if you have SMT already set. No, we do not have a proper SMT, because this swept this low and then swept it again. So I don't really trust this as a SMT. I'm anticipating that to be the markets just not moving in sync. So let's go to the next week, play price forward to Monday. Monday sweeps this low, and then I immediately look if the other assets did the same. No, the other asset swept the high and DXY's candle is not popping up. Now it is. So we have SMT at both the highs and the lows. Then I'm simply going to wait and look what the next candle does. We have a sweep. I assume that all assets took previous week's low, and this asset even took more than previous week's low. So that's immediately a SMT. Let's go to the daily. So looking at price like this, I would like it to be bullish. But what did I tell you guys about when the market is not moving in sync? We have a bullish candle on EU, bearish candle on GU. So I'm going to simply wait for the next daily candle. The next daily candle shows me everything I need to know. Previous day's high SMT on Wednesday between EU and GU. Now DXY is not properly loading, so I'm going to skip price forward. Okay, so this Wednesday candle on DXY also has SMT. Now with this previous day's SMT, I can trust that this will be the high of the sell program, because we have previous day's SMT and we have closed back under this range. So I'm going to remove all the fluff. And now we have set our whole narrative in play. So then based on a singular weekly closure, I have predicted what the week will do with the daily SMT into a closure. So we have a SMT right here, making me trust that this will be the high. We close under this low. Let's go to GU. Do we close under that low as well on GU? Yes, we do. Let's go to DXY. Do we close under that low on DXY as well? Yes, we do. So what is the next candle going to be? And that will be a potential tradable candle. We are likely going to attack these lows. Bang, we attack that low. We close under the candle, but not very strongly, but still we close under it. And we anticipate the next candle to also expand, which it did not. But if you look at DXY, it took previous day's low before becoming bullish. So maybe early day it expanded. Let's look at the hourly time frame. Yes, it did. So it expanded, left the SMT with DXY, and then the week was over. And that's how you simply can catch your buys, even when price. I just took the hardest piece of price action. I did not practice this. I just went off the script at the top of my head. Well, it was not even a script, and if it's on the top of my head, but that's how you can get a weekly bias, because now we had terrible price action, and that way by looking at the weekly candle closure, we have generated a whole weekly bias, and then on the daily, we have generated a whole daily bias, making us to be able to trade a potential Thursday candle, or maybe even the Wednesday candle when we have seen this SMT. And you'll learn those things in the next modules. I was just editing this example, and I was even impressed with my own market understanding. Don't forget, we were only looking at the daily. Once we go into the next modules, you will zoom into price more, which will make you be able to predict more and any move. But right now, we are learning how to create a bias with the daily candles, so we don't have information from the lower time frames, and we still rinsed it. You already know, man. Let's get it. If you've made it all the way to the end, then respect, because you're a small percentage of the real people who are willing to change. So I suggest you to rewatch everything, apply it in your charts, and take notes in your own words. If all you do is watch this episode again, then so be it, because you will pick up on so much information you've missed in the first time of watching. In the upcoming days, you should apply what I've been teaching. You should not consume any other knowledge from any other sources. This way you finally stick to one thing long enough to see if it works. Study my other videos in the meantime so that you can see the concepts being applied. Join the free Discord in the description. Tons of free value there, such as a trading journal and trade recaps, which I highly suggest you to watch, by the way. Also, make sure to connect with other traders in there and share your journey because trading is a lonely road. So you need a community of like-minded individuals around you to keep you on the right track. I repeat one last time, rewatch this episode until you understand everything, then apply it and see the workings of it in your own charts. That way you will see that what I'm saying is the real deal, but you already know because Oscay don't cap, you feel me? You've made it to the end. You're a small percentage of the people willing to change. Now be the even smaller percentage of the people that rewatch and apply the concepts. Because a lot of people just watch, and they don't apply. It's like looking at Kobe, shoot a 3-pointer, and then thinking you're going to shoot 3-pointers the same way. So you need to apply and get the reps in. Good luck in your journey, my bro. I appreciate you watching this to the end. Much love. Oscay. Peace.